Okay, I want to start with a number, just one number, and I want you to sit with it for a moment before I explain it. 3. 4%. That is the true tax rate paid by the 25 richest people in America over a 5-year period. According to the actual IRS records obtained and published by ProPublica, www.propublica.org, UTM_source equals chatgpt.com, not an opinion, not a theory, actual government tax data, the 25 wealthiest Americans saw their combined wealth grow by $401 billion between 2014 and 2018, and they paid $13.6 billion in taxes on that $401 billion of wealth growth, 3.4%. Now, I want to tell you what you probably paid in taxes last year. If you earn a salary, if you work for someone and receive a paycheck, you most likely paid somewhere between 25 and 40% of your income to the government, depending on where you live, possibly more. First, I need to explain something fundamental about how income is categorized in the tax system, because most people think income is just income. Money is money. You earn it, you pay tax on it, that's it. Right? Wrong, completely wrong. In the tax system, there are two completely different categories of income, and they are treated in radically different ways. The first category is called earned income. This is your salary, your wages, the money you receive in exchange for your time and your labor. And this income is taxed first before you even see it. Your employer deducts the tax before the money reaches your bank account. And the tax rate on earned income goes up the more you make. In America, it can reach 37% at the federal level. And when you add state taxes and payroll taxes, many middle-class workers are paying 40 to 45% of their gross income before they touch a single dollar. The second category is called capital gains income. This is the money that comes from owning assets. When the value of your stocks, your real estate, your business ownership goes up, that increases capital gains. And the tax rate on capital gains is dramatically lower. In America, it is 0, 15, or 20%, depending on your bracket, maximum 20%. And this is the critical part. You only pay this lower rate when you actually sell the asset. If you never sell it, you never pay. Your wealth can grow by $100 million in a single year. And if you do not sell anything, your tax bill is zero. Now think about this carefully. The people who earn money from salaries, teachers, engineers, nurses, accountants, they pay the highest rates automatically, unavoidably, before they even decide how to spend their money. The people who earn money from owning things, from assets, from stocks, from real estate, from businesses, they pay dramatically lower rates. And they have the choice of when to pay or whether to pay at all during their lifetime. This is not a coincidence. This did not happen by accident. These rules were written by Congress. And who has the most influence over Congress? The people who benefit from these rules. The people who own assets, the people who fund political campaigns, the same people who pay 3.4% in true taxes. Okay, now I want to talk about something that even fewer people know about, something that, when I first understood it, I genuinely could not believe it was legal. It is called the buy, borrow, die strategy, and it was actually named by a law professor, a professor at the University of Southern California named Edward McCaffrey, who came up with this term in the 1990s to explain to his students exactly how the ultra-rich use the tax code to build and pass on wealth without ever paying meaningful taxes. Let me explain how it works. And I want to be very clear, this is completely legal, every part of it. Step 1 is buy. You buy assets that go up in value over time. Stocks, real estate, businesses, art, whatever, appreciates. You hold those assets, you do not sell them. Because the moment you sell, you have a taxable event. You owe capital gains tax. So you simply do not sell, you let the value grow. And while it grows, even if it grows by tens of millions, hundreds of millions, or billions, you owe zero tax. Because unrealized gains, gains on assets you have not sold, are not taxed under current law. Step 2 is borrow. Now here's where it gets interesting. You have these assets worth, let us say, $100 million. You need money to live on, to pay for your lifestyle, your houses, your yachts, whatever it is. What do? You go to a bank and you borrow money against the value of those assets. You use them as collateral for a loan. And here is the critical thing. Borrowed money is not taxable income. The government does not tax loans. So you borrow $10 million against your $100 million in assets. You live on that $10 million. You pay a relatively low interest rate on the loan, and you pay zero tax on the $10 million because it is a loan, not income. Meanwhile, your assets continue to grow. You might borrow $10 million, but your assets grew by $20 million that year. So you are actually getting richer while living tax-free on borrowed money. Elon Musk did this when he bought Twitter. He did not sell his Tesla stock to get the money. If he had sold the stock, he would have owed billions in capital gains taxes. Instead, he borrowed $25.5 billion against his Tesla shares as collateral. Zero tax on $25.5 billion. Completely legal. Step 3 is die. This is perhaps the most extraordinary part. When a wealthy person dies, their heirs inherit the assets. And here's what the tax code says happens at that moment. Something called a step-up in basis. It means that the original purchase price of those assets is essentially erased. The heirs inherit the assets at their current market value. So all the appreciation that occurred during the wealthy person's lifetime, all the gains they never paid tax on, those gains are permanently wiped from the tax record. The heirs can sell the assets the next day and owe zero capital gains tax. So the full cycle looks like this. Buy assets, let them grow tax-free. Borrow against them to live on, tax-free. Die, pass everything to your children tax-free. Your children repeat the process. And in this way, dynasties of wealth are built and preserved across generations without ever paying meaningful taxes. Now compare this to what happens to you. You earn a salary. It is taxed before you receive it. What is left you spend, and you pay sales taxes on many of your purchases. What you manage to save, you put in a bank account or retirement fund, and when you withdraw it in retirement, you pay income tax again. And when you die, your estate may owe taxes on what you pass to your children. You are taxed on the way in, taxed while you hold it, taxed on the way out, and taxed again at death. The wealthy, through the buy, borrow, die strategy, are taxed at none of these stages. Okay, now I want to put this into historical context, because as I always argue, nothing about the present makes sense unless you understand how it was built. The income tax in America is relatively new. It was only made permanent in 1913 with the 16th Amendment to the Constitution. Before that, for the first 137 years of American history, there was no permanent income tax. The government raised revenue through tariffs, through excise taxes, through taxes on trade. When the income tax was introduced, it was initially designed to tax only the very wealthy. In 1913, less than 1% of American households earned enough to be subject to the income tax. It was explicitly a tax on the rich. But over the decades, as governments needed more revenue for wars, for social programs, for the massive expansion of the state, the income tax expanded downward. It captured more and more of the working population, until today, when ordinary workers are paying the highest effective rates. Meanwhile, the tax treatment of capital gains moved in exactly the opposite direction. In the beginning, capital gains were taxed at the same rate as ordinary income. But as the wealthy gained more influence over the political system through campaign contributions, through lobbying, through the revolving door between government and finance, the tax rate on capital gains was steadily reduced. It was cut in 1921, cut again in 1978, cut dramatically under Ronald Reagan in the 1980s, cut further in 2003 under George W. Bush, when dividends were also given preferential treatment. And today, capital gains are taxed at roughly half the rate of the highest ordinary income bracket. The tax code was not written to be fair. It was written over time by the people with the most power to shape legislation. And the people with the most power to shape legislation are the people who already have wealth. And they shaped it to protect and grow their wealth. This is not a conspiracy theory. This is documented history. This is how political systems work when they are not actively designed to prevent it. The people with the most resources use those resources to influence the rules, and the rules then serve the people who wrote them, okay? So now I want to talk about the third layer of the system, because the tax advantage is real. The buy, borrow, die strategy is real, but there is something even more fundamental that keeps ordinary people trapped in the high tax system while the wealthy operate in the low tax system. Thoughtful. And that is the difference in what they own. Let me use a very simple analogy. Imagine two people. Person A earns $100,000 salary. Person B owns a business that generates $100,000 in profit. Same amount of money. But here's what is different. Curious. Person A pays income tax on the full $100,000 before any expenses. The government takes 30 to 40% off the top. Person A has maybe $60,000 to $70,000 left to pay for their life. Person B owns a business. The business pays its expenses first, the office, the equipment, the travel, the professional services, all before taxes. What is left after expenses is what gets taxed. And that profit is taxed at the lower corporate rate. And if person B takes money out as dividends rather than salary, that is taxed at the capital gains rate, not the income rate. Moreover, and this is very important, person B's business expenses are things that the business genuinely needs, but many of those things also benefit person B personally. The company car, the business travel that also includes some leisure, the home office deduction. These things reduce the taxable income of the business while also improving person B's quality of life. Person A has none of these options. Person A earns a salary. It is taxed at the full rate. There is almost nothing to deduct. Person A cannot deduct their commute to work, cannot deduct their lunch, cannot deduct their professional clothing. The system gives person A almost no flexibility. This is why the structure of how you generate income, not just how much you generate, determines how much tax you pay. And the tax code consistently rewards the structure of ownership over the structure of employment. Okay, now I want to address the most important question of this entire discussion, and it is the question that you are probably probably asking right now, this is all very interesting, but what can I actually do about it? I am not a billionaire. I cannot borrow $25 billion against my stock portfolio. I am a regular person earning a salary. What does any of this mean for me? And I want to be very honest with you here because I am not going to give you false promises. I am not going to tell you that if you just watch this video and follow 3 simple steps, you will become a millionaire next year. That is not true. And I respect you too much to say it. But I am going to tell you what is actually true, what actually works, what the research shows, and what I have observed in my own study of how people build genuine financial independence. The path out of the high tax, high expense salary trap has several real and concrete steps, and none of them require you to already be wealthy to start. The first step is to understand the difference between a tax on your labor and a tax on your assets, and to begin, even in a small way, to convert some of your salary into assets. This is what every personal finance researcher, from Napoleon Hill to Robert Kiyosaki to modern financial economists, agrees on. You must begin to move money from the taxed first column into the asset column. The most accessible way to do this for ordinary people is through tax-advantaged retirement accounts, 401ks, IRAs, and their equivalents in other countries. When you put money into a 401k, that contribution comes out of your salary before income tax is calculated. That is the same principle the wealthy use: reduce taxable income by moving money into a different structure. For ordinary people, the tax-advantaged retirement account is the most accessible version of this. The second step, and this is slightly more advanced, is to begin building even a small ownership stake in something outside your salary. This does not mean you need to start a large business tomorrow. It can be as simple as buying a small piece of real estate. It can be investing in index funds that compound over time. The point is not the size. The point is the structure. Even a small portfolio of appreciating assets begins to move you from the pure salary column, where every dollar is taxed first and hardest, toward the asset column, where your money grows with tax deferral and at lower rates. The third step, and this is the one that almost nobody talks about, is to understand what you are actually paying. Most people have almost no visibility into exactly how much of their income goes to taxes, to lifestyle expenses, to interest on debt. Research consistently shows that people who track their finances in detail make dramatically better decisions, not because the information is complex, but because most people are simply not looking at it. When you see clearly, when you see that 38% of your gross income disappears before you touch it, and then another 40% of what is left goes to fixed expenses, leaving you with 20% to work with, you make different choices. You see where the leaks are. You see what can be redirected. And the fourth step, this is the long game, is to understand that the goal is not a higher salary. The goal is passive income, income that arrives without you trading your hours for it. The salary trap is fundamentally a time for money trap. The exit from the salary trap is building income streams that do not require your time. Even a small amount of passive income, $500 a month from a rental, $200 a month from dividends, $300 a month from a small business you built, changes your psychology. It changes what is possible. It gives you options. And options, not a bigger paycheck, are the true definition of financial freedom. Okay, let me bring everything together, because I want you to leave this lecture with a very clear understanding of what we discussed. The tax system has 2 sets of rules, one for people who earn money by working, one for people who earn money by owning. The first group pays 25% to 40% or more. The second group, through strategies like buy, borrow, die, can legally pay 3% to 4%. Or in some years, nothing at all. This is not illegal. It is the system working exactly as it was designed to work, by the people who had the power to design it. The productivity of ordinary workers has grown by 90% since 1979. Their pay has grown by 33%. The difference went to shareholders and asset owners. This is the most concrete evidence that the economic system is not a neutral meritocracy. It has consistent structural biases that move wealth upward, regardless of how hard ordinary people work. And yet, and this is the part I want you to hold on to, the same structures that the wealthy use are accessible in modified form to ordinary people: tax-advantaged accounts, asset ownership even at a small scale, passive income even in small amounts. These are not billionaire strategies. They are the fundamental principles of how the tax-advantaged side of the economy works, available to anyone who understands them and begins to use them. The question is not whether the system is fair. The only question that actually changes your life, is whether you are going to understand how it works and use that understanding. The people who built this system understood it very well. It is time that you do too.